Welcome back, everyone. Michael here with Offshore Citizen. Today we are going to discuss supply chains, inflation, and recessions. And in particular, we're going to talk a little bit about how a lot of what people think about how things behave during an inflationary period are not accurate to how they actually behave, and how this affects what you should basically be doing in quite a different way. So I will explain it to you, and if you have any questions, put them in the comments below, but I hope you enjoyed the video. Before we get going though, if you wouldn't mind hitting the subscribe button, hitting the all notification bell, thank you very much for your support, really appreciate it. And if you would like help with international tax optimization, forming companies, opening bank accounts, relocating abroad, etc., please reach out to us. You can book a call, calendly.com/Michael-Rosmer, link in the description below. Or you can send a message to our websites, offshorecitizen.net and offshorecapitalist.com. All right. So here's the basic idea. We've clearly had various different supply chain issues. There was on the All In podcast a few episodes ago a really great that a guest on who walked through a bunch of the issues that are going on and why they're happening, etc. Bottom line is we've had a bunch of supply chain issues and we've had inflation that has been running quite hot. Now, I'm going to do a video in the future where I talk about the difference, which is a subtle but important one that a lot of people don't get, between devaluation and inflation. And that's, you can see it right now in Russia. The Russian ruble has collapsed, and that's a devaluation, which is different than inflation. Okay, so worth understanding that difference, and I'll talk about it in some future video. For today, though, we want to talk about inflation, which is really about prices rising. Okay, and what I want to specifically talk about is what happens when you get prices rise, and therefore what would we expect. And to understand that, it's worth understanding to some extent why we care about measuring CPI. Okay, so CPI very clearly is not a measure of the prices of everything going up, right? Obviously we have financial assets that go up a lot, they're not measured in CPI. A bunch of aspects of housing and some other things aren't measured in CPI. Then there's the idea that it tries to account for some things that people's buying behaviors change, and that doesn't accurately reflect CPI, like real price changes. This is called substitutions. So just quickly for those who aren't familiar with this, maybe you go from buying Armani to buying Guess to buying Zara, right? And so what will happen is that the price of clothing looks like it isn't going up as much as it is. If you measured consistently looking at Armani, you'd see the price has gone up a lot, but what happened was there was a substitution. People stopped buying Armani and they started buying Guess. And what this means is that the perceived value of that basket has gone down. Now, this behavioral change is really obvious when you consider the fact that, of course, people don't have enough money when things go up too much, and so they're going to change their buying habits. But it gives a deceptive figure to CPI as compared with what some people would call real inflation. Okay, so why is it that it's worth measuring CPI? Because I think a lot of people view CPI as being something that measures real inflation, and I don't find that that's the usefulness of CPI. CPI is a very useful figure for helping us to understand recessions. And to understand this, let's talk a little bit what happens in a recession. So obviously recessions, for those, pretty obviously, is when we have kind of consistent long-term price downturn in financial assets, or negative economic growth for a period of time, okay? And so, obviously most of the time things are kind of flat or going slightly up, and then you'll have a period of time when things go down. And if you can watch Ray Dalio's How the Economic Machine Works, he does a great job of doing a video of showing how accumulating debt automatically leads to this short-term and long-term debt cycle, and it's a great explanation. But the thing to understand is okay, why does that happen? And of course, there's psychology behind it, there's debt behind it, but what's also important behind it in terms of just what the mechanics are is that people no longer have more money to put into increased spending, okay? So in other words, things grow because people are continuing to cycle their money back in, and they're continuing to build and buy, build and buy, build and buy, build and buy, which creates growth. And then at some point in time, for one reason or another, they no longer have that money to continue the build and buy cycle, and so they start not buying, which means that you have this inverse cycle downward. Does that make sense? Hopefully it does. All right, so the question then is, what is the nature of recessions? And what a lot of people don't quite understand is that there's two types of recessions. There's inflationary recessions and there's deflationary recessions. A deflationary recession is what we saw in 2008. And this essentially is where you have debt that people can no longer pay. And what will end up happening is that you will have credit bubbles pop, right? In other words, the supply of credit decreases, which means that there's less money to spend, which means you have this contraction of the economy. And that's happening because of the fact that people can't afford to pay their debts, therefore they default, therefore assets have to get sold, therefore the supply of goods and services on the market is going to increase, right? Which drives their relative cost down, and it has this cyclical effect up to a certain point. It cascades. The one that people don't think about so much, and maybe it's partially because the last major spike in inflation in North America was kind of late 70s, early 80s, are inflationary recessions. And what happens in this case? Well, what happens is people end up in a situation where, because prices are rising, okay, they have less money that they can spend on other things. So this is really apparent if you look at, for example, people have, let's just say, excess cash of, $1,000 a month that they're putting into the stock market. So you've got this continuous flow of capital that's going into financial assets. But then what happens is their cost of living goes up, just let's say, for instance, this by 10%. And 10% of their total, extracts $500 a month from what they can afford to put into those financial markets. Well, now instead of $1,000 a month going in there, there's only $500 a month going in there. And of course, there's going to be psychological effects here where maybe they're going to go and they're going to try and invest more aggressively at one point in time in order to try and make up for this gap. Or maybe they're going to start saving more because they're worried that they may not have enough in the future. They want to create a buffer. There's psychological factors that happen, right? But the bottom line is there is less money to attribute into financial assets. And when there's less, or consumer spending in general, right? So people cut down on their disposable spending because of the fact that they can afford less. And this is where substitution effects are important, right? Because if somebody goes from Armani to Guess, or Guess to Zara, and they continue to consume at the same rate, and they still have the same excess amount of cash that they can put into financial assets or discretionary spending, then it doesn't matter that there's not an equivalency in what they're buying, okay? It's useful simply to know how much of people's budgets are being consumed by the cost of goods. This is what CPI is useful for, in my opinion. So what happens is, now they have less to spend. Because they have less to spend, this means that it cycles through the market, right? If there's less discretionary spending, what you'll see is people whose businesses rely on that discretionary spending, those businesses start to decline. Financial assets that are relying on more and more people coming in start to decline. Some of the people are going to start to default on their debts. That's going to create a decline, etc. So, important thing to note, inflation can cause recessions, just like deflation can cause recessions. Here's the thing that's interesting. What people seem to believe, because in part they confuse devaluation with inflation, is they tend to believe that financial asset prices will go up in an inflationary environment. And this is actually often the opposite of what is true. You can see this, for example, in the late 70s, right? The late 70s we had high inflation. Now, yes, it's true, they raised interest rates, etc. But what you saw is that there's actually a strong negative correlation between rising inflation rates and declining stock prices. Quite interesting. But when you think about it, it actually kind of makes sense. Because what happens? People have less consumer spending. Because they have less consumer spending, this is going to simultaneously have two effects. One is the companies are going to have declining earnings, and which means their relative valuations are going to decrease. And second of all, the people are going to have less money, which they can invest into financial assets, which is also going to put less buying pressure, which is going to mean that the prices are going to decrease. So that effect has actually the opposite effect of what people might think. Now, yes, there are some things that will not be affected in the same way. For example, housing tends to have a different effect on it than just pure financial assets. But I think why I wanted to make this video was to explain how the effect of inflation is principally that people have less money to spend. And the consequences of people having less money to spend ultimately means that you're likely to kick into a recession, which is going to mean declining financial assets. So people who think that they're hedging against inflation by buying financial assets actually that's not going to be true. It might be true early on, like you'll have this early kind of spurt, but fairly quickly, it's not the case. Fairly quickly, the net amount of money is coming out. And obviously there's other countervailing forces, right? You might have the Fed is pumping a lot of money into the system, and that's counterbalancing it. People are borrowing a lot of money, and so that's counterbalancing it. But the longer you go on and the more volatility you get, the more rapid this is rising, the more of an issue it's going to be. Now, last point, there is a difference to some extent between hyperinflation and high inflation. So hyperinflation is just, ridiculous, out of control. Some people, there's no actual formal definition, but some people will define it as, 50% inflation a month, right? If you're talking about, 10% a year, then that's obviously dramatically lower. The consequences are different because in an extreme hyperinflationary environment, the velocity of money increases out of control. People are spending really, really quickly because of the fact that that money is not going to be worth much the next month, right? Similar to an extreme devaluation, right? Whereas when we have high inflation, 5, 10%, especially if it's rising up, it's not high enough to drive a significant behavioral change. There's not that tipping point in the sense that people want to just get rid of their money, right? They're still wanting to try and protect. They still have some reasonableness, and this is likely to have a different consequence on the market overall. So don't confuse the way that people behave and what you should do with your money in a hyperinflationary environment with a high inflationary environment. So anyway, I hope that helps. If you have questions, put them in the comments below, and I look forward to seeing you on the next video.